Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Mullen Automotive, Tesla, AMC, NEO stock, as well as Sofi Technologies. If you want any more stock news updates on any of these companies, remember to go and smash that like button right now, comment down below what company you want me to analyze next, subscribe if you are new, and without further ado, let's jump right into today's stories. So we're going to start off with Mullen Automotive, which is an electric vehicle manufacturer who is currently bringing over commercial electric vehicles to Europe, which should increase their current share price. However, we do have some negative bearish news considering that one of their directors has recently sold off a large portion of their overall shares, and that's not good to see, an insider selling off shares while the share price is rather cheap right now. However, investors are clearly playing off of both of these news events to trade the company in the meantime, and I will also add my own personal opinion once we get to it. Up next, we're going to go over why Tesla's TSLA stock is tanking right now due to their negative delivery numbers that they brought in, which has caused a few analysts, particularly a professional from JPMorgan, to issue a newer, lower price target for Tesla. So of course I'll be adding my own personal opinion on that, as well as where I think the TSLA shares are headed in the future. But don't fret, because I really like Tesla overall. It's a fantastic company. After we discuss Mullen and Tesla, we're going to move on over to AMC, which I will just briefly talk about regarding how the CEO believes their overall share price will increase throughout the year of 2023 due to the amount of movies that will be released in theaters this year, which is going to add a lot of good and positive revenue to the overall business. But of course, there is also some negative news that I want you to be aware of. After that, we will actually compare and contrast two Chinese electric vehicle makers, such as NIO and Li Auto. Now, in this article, we will compare and contrast them to determine which one is the best stock investments for investors overall, as well as which of these companies I personally like and own more of. Lastly, we will end talking about Sofi Technologies SOFI stock and why this particular author believes that Sofi should be valued as a banking company and not necessarily as a technology growth company. So we will be analyzing that article as well. For more videos, remember to go and smash that like button right now if you haven't already. And without further ado, let's start with our first story, which is going to be about Mullen Automotive. Mullen Automotive, like I said, is an electric vehicle manufacturer who currently trades at just 31 cents per share. Many investors believe this is an opportunity to get rich relatively quickly because they believe this company is going to be extremely lucrative in the future. And clearly there's no denying that electric vehicle manufacturer Mullen Automotive, ticker symbol MULN, can prove its value to shareholders in the year of 2023. Because the Mullen share price is so cheap right now, clearly there is huge upside potential, but there are some investors who aren't convinced yet, and I will be going over the data which is actually preventing them from investing into this company. Right now, the United States government is pouring billions of dollars into electric vehicle infrastructure around the United States, and this is going to support a build-out for various electric vehicle manufacturers, thus causing the overall share price of these companies to increase, including Mullen Automotive. However, as of late, multiple electric vehicle manufacturers worldwide have undergone some scrutiny due to supply chain constraints, and that is what is actually anchoring some of the overall share prices for more well-known and established electric vehicle companies. Mullen is one of the newer startup electric vehicle companies that people aren't very comfortable investing into as of right now. But don't think that should give you an option to short the overall MULN share price right now, because there could be a very good bullish thesis for this company, which according to investors is still completely intact. But I think, as well as the author of this article believes, that smart investors should wait to buy this company, wait until they actually prove themselves. And this is what I mean by that. Right now, we have had both bullish and bearish, or positive and negative news come out about this particular company. The good news is that Mullen Automotive is venturing boldly into the European markets by giving them commercial urban delivery vehicles which run off of electricity. And they've also landed a multitude of lucrative deals with various dealerships and other EV companies. However, most of these companies are not profitable and were about to go bankrupt, so I'll leave that up to you to determine if those were good acquisitions or not. not. However, this doesn't mean that investors need to buy Mullen right now. If anything, investors who are buying Mullen hand over fist are somewhat confused because they believe this company is going to skyrocket when it definitely could. I'm not saying Mullen is a bad company, but it's clearly wiser to wait for this company to prove themselves first. One of the reasons why investors such as myself are not buying into the company as of right now is because one of the directors sold off 100,000 shares worth 33 cents each, and that's really not good to see an insider do this. Whether or not it was already put in the books when this insider was going to sell his shares, it doesn't matter. Investors or insiders selling their shares are normally not a good sign unless they are trying to pay off taxes or tax loss harvest, but in this instance, the insider wasn't doing that. So I would say we should wait for more information before buying into Mullen stock. For the investors who are already in this company and believe in the future of the electric vehicle market, I say there are multiple ways to do this. Mullen is not your only avenue to becoming much wealthier by investing into electric vehicle companies. For instance, just this video is going to talk about a total of 4 electric vehicle companies who are each one better than the other. Clearly, Tesla is going to be at the top of my list, but if you have a very strong portfolio, you're already up tremendously, investing a slight amount or a small amount of money into Mullen stock could be for you. However, for me, I will not invest into Mullen Automotive until one of 3 things happen. Either they have substantial deliveries and manufacturing numbers, the company becomes profitable, or they land a giant deal which would rival any of the existing American electric vehicle companies to compete with Lucid, Rivian, or Tesla, or even Fisker for that matter. But as of right now, clearly Mullen is a more speculative electric vehicle company to invest into. Now, this doesn't mean that Mullen is a bad company, it just means that I would rather wait for this company to prove themselves before they earn my hard-earned money. So clearly, I want you to be aware of the risk and the reward that comes along with this company. So please be careful, don't allocate too much to risky singular growth stocks who haven't proven themselves yet, and as always, take profits when you can. Moving on to our next company, I'm actually pretty surprised because Tesla has been in the news lately due to negative developments for the company. If you're not already familiar with this company, Tesla is an electric vehicle manufacturer which also specializes in energy generation as well as energy storage. Right now, the TSLA share price is trading at just $105 per share, while investors believe the company should be worth around $243 for the year of 2023. Recently, Tesla had a very bad 2022 with the share price falling around 65%, and recently Tesla released lackluster or not very impressive fourth quarter delivery results in 2023, which has caused the overall TSLA share price to drop by around 13.62% right now. So clearly this is not a good or positive development for Tesla. Now let's actually dive into these delivery numbers if you're not already familiar with them. Tesla saw fourth quarter deliveries rise by 18% sequentially to around 405,000 vehicles, which missed their overall expectation and forecast of delivering 418,000 vehicles. However, I would still say a rise of 18% is still pretty strong. Also, if we look at Tesla's 2022 total deliveries, which number close to 1.3 million units, that's up 40% year over year, but still below the overall projections and guidance, which should have met around a 50% growth rate in terms of their overall deliveries. But still, 18% and 40% are still extremely high, and I am still impressed with this overall company. Now, the bad news is that a JPMorgan analyst recently actually cut his profit estimates and price target for Tesla and their TSLA stock price in the wake of these actual delivery results. For instance, in 2023, the analyst now believes for the full year that the company is going to bring in an EPS of $4.60 instead of his previous estimate of $4.84. But even if they brought in $4.60 per share, I would still say that is a positive development. But what about his overall share price targets for this company? Well, the analyst actually lowered his price target from $150 down to $125, which is a 12-month stock price target, and he actually gives it an underweight rating or a sell rating. And I completely disagree with him. Right now, the share price is trading at just around $105, meaning that if it drops below $100, even if his low-end price target is correct of $125, this is still presenting upside for Tesla shareholders, and that's when I'm going to start buying this company if it drops below $100 per share. So overall, I personally am still bullish on Tesla's TSLA shares, and I expect great things from this company in the future. Up next, we're going to briefly talk about AMC, which was a huge stock back in the day, and some people just wanted me to give a quick update on it. Now, if you know me, I am not a fan of AMC. I said for investors not to invest into this company, that literally you are getting played by hedge funds, and that everyone was just listening to their emotions and market psychology to determine what they should invest into, which is literally almost never fruitful for an investor. AMC owns a large chain of movie theaters, and right now their current AMC share price is trading at just $3.90, while investors actually believe this company could fall down to around $3 or lower. And clearly I believe that. I don't own any AMC, I don't plan to own any AMC, and I expect the share price to continuously drop. Why? Because if we look back at AMC, we can tell just from their history that this company does not have good management. The overall share price has dropped substantially for many years, and I really don't see anything that is going to change or turn the tide for their share price. Now, the CEO is arguing that he believes as more movies and box office numbers increase throughout the year of 2023, this will increase their overall revenues for this year. And I agree with him. However, an increase in revenues is actually not going to do what he thinks it's going to do. For instance, he says, and I quote, "So much garbage info spreading about AMC by twisted conspiracy theorists. Our real challenge, among others, is the industry-wide domestic box office of $11.4 billion in 2019, and now it's only around $7.4 billion as of 2022. However, he believes that the overall domestic box office revenue will return to $11.4 billion or even greater by increasing by around 64%. And I know I started out quoting him, but honestly, his quote just doesn't add up in the sense of even if box office numbers increase and it causes the revenues to rise, that's not going to solve AMC's problem with their overall debt and share dilution. So what I have to say about this company is you probably should stay away from this company because the AMC saga as of right now is either put on hold or is completely closed out. Now you can say what you will, however, if you look at the overall share price and my previous predictions, I have been right more often than not when it comes to AMC. So please, before you comment anything, make sure that the data is on your side. You can't use data or things that haven't happened yet. You have to use things that have happened. And as of right now, I think AMC is too risky to invest into. Clearly, I'm going to keep an open mind, and I could change my mind on both AMC as well as Mullen Automotive if they show some sort of reversal in their overall business or if they meet certain criteria. But as of right now, they are just too risky to invest into for my taste. Next up, we're going to talk about two electric vehicle companies that are headquartered over in China, and that is NIO as well as Li Auto. NIO is an electric vehicle manufacturer which currently trades at just $9.57, while professionals believe the company could surge to around $19.46. On the other hand, we have Li Auto, which is trading at $20 per share, while investors and professionals believe the company could surge to $34 over the next 12 months. This particular article is going to compare and contrast both of these companies because both of them are extremely rapidly growing electric vehicle companies, except for Li Auto, they're more of a hybrid company because they make hybrids, not fully electric vehicles technically. The author believes that both of these companies are going to make a huge turnaround in 2023, and their overall share price is somewhat undervalued right now, and we'll get into that right now. But what's the difference between NIO and Li Auto? Well, NIO sells 4 types of SUVs and 2 types of sedans. They also have a very impressive supercar called the E9, which they produced back in 2016, which is a really cool looking vehicle. While on the other hand, Li Auto doesn't specifically produce fully electric vehicles like NIO does. Instead, they manufacture plug-in hybrid electric vehicles, which also are powered or can be powered by gas. So they're powered by both gas and electricity, and that is clearly a main difference. Now, they are somewhat similar in the sense of NIO has built out a network of battery swapping stations and a network of charging stations, while Li Auto has built a traditional network of first-party supercharging stations to charge their various vehicles. Except NIO clearly has the advantage here with their battery swapping station. So this then begs the question, now that we know how they're similar and how they're different, which company is growing faster? Well, it honestly matters what metrics we're using. So NIO delivered more vehicles than Li Auto back in 2020. NIO delivered around 43,000, while Li Auto delivered around 32,000. However, since then, Li Auto has actually caught up and overtaken NIO in terms of delivery. In 2021, NIO ended up delivering just 1,000 vehicles more, but in 2022, as you can see, Li Auto has surpassed NIO in terms of overall delivery numbers. So both automakers are growing extremely rapidly. Just look at their overall growth rates on screen right here for this chart of going from 43,000 to 91,000 to 122,000, and the growth rate is anticipated to continue. However, now I want to expose you to their overall revenues and financials. So NIO's revenue rose by around 122% to around $5.7 billion in 2021. NIO also hasn't posted a full year earnings report or numbers as of right now. However, professionals believe that their revenue is going to increase by around 42% for the full year of 2022, and it's going to grow another 89% in 2023. So this company is primed for growth in 2023, which is why I personally own it. On the other hand, we have Li Auto, which grew their revenue by 186% to $4.2 billion. So clearly they grew more than NIO. However, their overall top of the line number is less than NIO. Jumping over to the full year metrics of 2022, which haven't come in yet, analysts expect their revenue to rise by 68% for the year of 2022, beating out NIO's increase of just 42%, and in 2023, the revenue could increase by around 106%, again beating NIO out. But in total revenues, literally, these companies are much closer than previously anticipated. Now, I do want to say that NIO is trading at a cheaper market valuation at only $16 billion compared to Li Auto's $20 billion. So with a NIO having higher revenues and a lower market cap, this makes them a better buying opportunity in terms of value. But we do need to take these estimates with a grain of salt. We really don't know what's going to happen, and there is still potential of Chinese electric vehicle companies and just Chinese stocks in general being delisted from the American stock markets. However, there are talks and various agreements and potential agreements between the United States and China that will prevent US listed Chinese vehicle stocks from being delisted, and I think that's what's ultimately going to happen. I just want to make you aware of that. But as of right now, both of these companies look dirt cheap compared to other companies on the stock market. For instance, NIO trades at just 1.1 times their overall 2023 sales, while Li Auto trades at 1.5 times their forward PS ratio for 2023, and that is absolutely insane. These companies are growth companies, but they're essentially trading for value company prices. The author of this article concludes that Li Auto is actually the winner here, but I say it's clearly a toss-up, and I personally like NIO better just because they have more of a cult following. But honestly, I could go with either of these companies. They both have very strong revenue growth, very good vehicles, and I hope that the US and China can come to some sort of agreement for US listed Chinese companies. And also, because these are foreign companies, there is going to be political risk. Therefore, if anything happened over in China or between China and the United States, these companies are going to decrease in their overall share price. But as of right now, I personally own NIO and Li Auto, but I own a little more NIO. However, I would always recommend you do your own research. Both of these are phenomenal companies that are trading for relatively cheap. So at minimum, go ahead and put it on a watch list. Lastly, let's talk about Sofi Technologies, which essentially operates as a digital bank. They offer an all-in-one inclusive digital app that tries to specify and target young high earners. Sofi Technologies, ticker symbol SOFI, trades for just $4.46. While professionals believe this company could surge to $7.33 over the next 12 months, however, very bearish professionals believe this company could fall as low as $3.32 or 36 cents, depending on what analyst you talk to. If the company ends up dropping that low, we could see a reverse stock split in this company and an overall downward trajectory. Now, I still like Sofi Technologies because I believe in the long term, over the next decade, this company could be very lucrative. But with that being said, I own around a 4% allocation to Sofi Technologies. For instance, if my portfolio is worth $100,000 $10,000, I only have $4,000 attributed to Sofi Technologies. So it's not like I have a giant exposure to Sofi Technologies because it's still a risky growth stock. This author summarizes and he says that retail investors are thinking of Sofi Technologies as a technology growth company, but they should be valuing this company based off of their overall bank valuations. So instead of saying that Sofi is a technology growth company, honestly, we should be comparing them with other like-minded banks according to their overall valuation. And I honestly agree with the author on that particular point. However, I don't think it's here nor there. I think we can both establish them as a technology growth company as well as a banking company. He says there is a lot of risk for Sofi Technologies issuing out unsecured personal loans, becoming an unsecured personal lender, and I do agree with him as well. However, unlike him, I am convinced that Sofi Technologies is growing extremely rapidly and that they will eventually reach profitability at the end of 2024. He highlights that they currently lack profitability on a generally accepted accounting principles basis, also known as a GAAP basis, which he is correct when he says that and points that out. However, clearly they have a good growth trajectory, which will make them profitable by the end of 2024. There is still a bullish narrative and thesis that is intact for multiple investors and Sofi Technologies as a company, but that's only if we judge Sofi Technologies as a technology company and not necessarily a bank. The author highlights that retail investors are focusing on metrics such as top-of-the-line revenue growth, which Sofi is doing a phenomenal job at scaling. However, the author says that this is the wrong metric to identify. Instead, we need to do return on equity, profitability, unit economics, efficiency, and etc. However, I would say without the growth in revenue, you're not going to get all of these other financial metrics, but I do see his point. If we look at Sofi Technologies as an online bank instead of a growth company, there are other better investments such as Charles Schwab, JPMorgan, Bank of America, and Ally Financial as compared to Sofi Technologies. But if we continuously invest into Sofi Technologies or wait for this company to drop down to around $3, this could be a phenomenal company to buy and hold for the long term. So I would love to hear your thoughts on Sofi Technologies and any of the companies or stories that we went over today. Remember to go and smash that like button for more stock market news updates and analysis on any stock that you want. Subscribe if you are new, and I'll see you in the next YT video.